Hello, everybody. It's Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. One of the most common questions I get from investors really relates to when they've seen the price of a stock drop. Okay. And, they'll ask me, XYZ stock price has now recently dropped. Does that automatically make it a good buy? And again, it's very commonly asked. I recently had it asked, and I'm going to start out by talking about, I had that very question on Bristol-Myers Squibb here, and I'm going to illustrate that to you here in a moment. But here's the point I want to make is, and I've talked about this quite often in the past, not all price drops are the same. Warren Buffett once quipped something, and I'm paraphrasing, I'm not quoting, something about, unfortunately, people take their leave too often from stock price movements. Just because the price goes up or goes down, Peter Lynch also said, doesn't mean that you were right after you buy a stock. The point is, not all price drops are the same, nor are all price gains. And you have to make that distinction between whether the price has fallen into attractive value or it's still overvalued, the magnitude of the drop, where the drop came from, et cetera. And I'm going to try to illustrate that throughout this video here. So let's go ahead and turn to FastGraphs, as I like to do. And let's start with the first discussion looking at Bristol-Myers Squibb. Now, what I want you to see, I was recently asked, as I mentioned, to talk about Bristol-Myers Squibb based on this price drop. Now, there's a couple of things about this that I think are interesting. Number one, if you look at that price drop, it should become very clear by looking at this graph that that's really not that big a deal, number one. Number two, even though from a standpoint of actual mathematics, it actually is a pretty big deal. Let me show you what I mean. In other words, this is the type of drop that most people would consider to be a large drop. It's about a 13.8% drop from the peak to the bottom here. So, the stock fell double digits, if you will, but the stock was already extremely inexpensive when it fell. It was trading at only a 9 blended PE ratio, and now you can buy it at a 7.98 PE ratio. So it went from being very, very inexpensive to even more inexpensive. And all that did because nothing really changed about the fundamentals. Nothing has really changed about the dividend expectations of the company. The only thing that really changed is that the price dropped. And all that did in this case was create a better bargain out of a stock that was already a bargain. And I want to illustrate. I chose this one as my first example for a couple of reasons. Number one is you can see this in the past. You can see this drop from very high valuation on Bristol-Myers back here in July of 2016 when the PE was 27, and we saw the price drop. I'm just picking a close to the bottom spot here. The PE fell from 27 to 20, which is still very high, but this was a 25% drop, okay? So the point I want to get at is Bristol-Myers was very, very expensive when that drop occurred. It fell and it remained very expensive even after the drop occurred. So now, just to put that into context for you, if I measure, what happened after that, you would have gone almost 3 years here from October of 2016 to July of 2015, where you'd have actually had a negative rate of return on Bristol-Myers Squibb, despite the fact that the price had already fallen, a significant, it was almost cut, fell almost 25%. So not all price drops are the same. Has my attitude about Bristol-Myers changed since this recent price drop here that we've had? And my answer is absolutely not. I think the stock is extremely well covered. It's an A+ rated company. It has a very strong balance sheet. If I look at it from a standpoint of other metrics, things like operating cash flow, I've got very good dividend coverage on the operating cash flow. It did get a little iffy back here, I might point out, but I've got good operating cash flow. And then if I go ahead and check free cash flow, which I like to check, I've also got very strong free cash flow coverage, at least in recent years here, relative from, are the cash flows covering the dividends? Now, I'm expecting double-digit growth of free cash flow over the next couple of years. As far as operating earnings go, I'm not looking for extremely high growth. So the point is, the analysts are expecting very high cash flow growth, not so much on earnings, but regardless, even if I value this at, whatever multiple I want to value this, whether I use the normal PE or the more conservative, what I'll call 15 PE, which gives me an earnings yield of 6.5 to 7%. I've got an extraordinary opportunity here looking at what type of rates of return I could be making in the next couple of years. And I've got an A+ rated company paying me a 3.5% dividend while I'm waiting. And I might add, a company that, if I look at this from a standpoint of their long-term dividend record, they have a good record of growing their dividend, and they've actually been growing it faster in recent years than they have historically. Now, it doesn't have spectacular dividend growth because you can see the company didn't do very much from the recession of '01, actually even past the first 2 or 3 years after the Great Recession before it started growing again. And by the way, that's very typical. If I looked at Merck or Pfizer or any of the other what I'll call large pharmaceuticals, they all kind of look like that, and most of them are starting to see an expansion of growth here. But the point is, this price drop was not anything that changed any of my thinking at all about Bristol-Myers Squibb. Now, in contrast, if I look at one of my favorite stocks in the world, Church & Dwight, it's a BBB+ rated stock. There were years and years and years where you could buy this stock at around 15 times earnings. I want you to see that so many times. It touched that. Then it got out of the recession. Now we've been on this wild, high valuation. It has lasted several years. I don't discount that. I don't try to deny that. And I certainly have seen it before. This happened with the Nifty 50 era way back years ago. It also happened with the irrational exuberant era, not just, back to the late 1990s, 95 to 99. But here we've had a significant drop in price. But this, again, has not changed my attitude about this stock at all. I still think it is a significantly overvalued stock, and I have no interest in researching it further at this point, nor do I have any interest in, thinking about investing in it now, because just because the price has dropped does not change my attitude. Now, I want to illustrate this with some cyclical stocks as well, because it works just as well with them as it does typical stocks. Take a look at Caterpillar. Caterpillar has had a real strong run here. And again, anything associated with, possible infrastructure building has done, pretty well from a standpoint of earnings expectations. A lot of the stock prices have risen dramatically. We saw that with Caterpillar. Here's a 15.7% drop since May of this year, through October 20th, yesterday's close. But I still consider the stock significantly ahead of what I call its earnings justified valuation. I don't think this is a buying opportunity for Caterpillar. Now, it's a better buy today than it was in May, but just because the price dropped does not make it a good buy. Now, in contrast, if I look at another cyclical stock that also has a history of cyclicality, I look at Cummins. It has recently dropped, and I just featured this in a video not too long ago. It's only dropped by 11%, but it dropped into fair value territory. Now, as I said in the video when I covered Cummins, I think Cummins is fairly valued now, but it's fairly fully valued, meaning it's not at a big discount. Earnings yield that I consider attractive is 6.7%, 6.67 to be precise. This is 6.26, so it's close, and it's certainly within my fair valuation range, considering that I doubt these numbers will be perfect, but I don't have the margin of safety that I would have had, for example, if I bought it in March of 2020. So even though I like Cummins very much here, I would still be patiently looking for a little more of a break before I actually purchased it. Okay, and then, another, good example to look at is Clorox. Let's look at what's happened to Clorox. Clorox has had this massive overvaluation that to me was just clearly extreme by looking at this graph. Even though the market, this is one of those stocks that the market likes to put a 20 multiple on. That's what the blue line here, it's a 20.75 PE ratio. It got crazy overvalued up here at a PE of about 27, here at this peak. And then recently, it's fallen 32%. So it's actually had a price drop greater than any of the other stocks I've shown you so far. And I still lament, because I love this company. I would love to own this company. And of course, this company was a COVID play for a short period of time. But even though the stock price has fallen as much as it has, I still believe the stock is significantly overvalued relative to how the market should be valuing a company with expectations of only 4 or 5% growth going forward here. And that's all analysts are expecting. Its long-term growth has only been 6.86%. And if I shorten that time frame a little bit, you can see more recently it's been in the 5.5 to 6% range. So I don't see a lot of growth potential here. I've got a nice dividend yield and a very excellent long-term dividend record, I might add, with this company. You can see their dividend has been spectacular, but the problem is you can overpay for even the best companies, and I don't want to overpay for Clorox today, notwithstanding the fact that I've had this substantial drop in price. Now, in contrast, and I'll end with this, if I look at Amgen, you can see how Amgen has been valued at a 15 multiple. It's expecting a little bit of weakness in earnings this year, but only modestly so. It'll still be like the second most profitable year the company ever had. I can get over a 3% dividend yield. I can buy it with an earnings yield of 7.8%. And it has had a price drop as well. But as you've seen here many, many times in the last just 4 or 5 years, what a tremendous opportunity to invest in a very high quality, world's largest biotechnology company with more than a 3% dividend yield and a very powerful, they've only been paying a dividend, by the way. This was primarily a growth stock. They've only been paying a dividend since 2011. Nevertheless, during that time, they've grown the dividend at a substantial rate, one of the fastest dividend growth rates of any company I follow. It's forecast to continue growing only at about 5 or 6%, which isn't spectacularly high, but at still, because of PE expansion potential, I can make double-digit rates of return over the next 2 or 3 years and collect a 3.39% dividend while I'm waiting. The moral of the story is not all price drops are the same. If a stock is dropping from fair value, or even like in Bristol-Myers' case being undervalued, that to me is just creating a greater opportunity. If the stock price is falling from an excessively high valuation and it's still highly valued even after the price drop, that is a totally different animal than, something that's fallen into fair value or even now giving you a margin of safety like you see here with Amgen. I hope that makes sense to you. Not all price drops are the same. You've always got to apply valuation. Like I always say, measuring performance without simultaneously measuring valuation is a job half done. Anyway, this is Chuck Carnevale. Hope you enjoyed this video. I just wanted to cover that one little feature about price drops. Just because a price drop does not mean I automatically like the stock, but it doesn't mean I don't like it either. Measuring performance without simultaneously measuring valuation is a job half done. You've always got to apply, in my opinion, as Mr. Valuation, the principles of value to the decisions when you're making them. All right, this has been Chuck Carnevale. I hope you enjoyed this. If you did, give me a thumbs up, give me a like. Subscribe to the channel if you haven't already, and take a look at Fastgrass. I've been featuring the new version of Fastgrass. We're actually testing it now. We're hoping to launch it very, very soon for those of you who have constantly been asking. So, look for it. It's really a neat new tool, and I know that all of you existing subscribers are going to find it worth waiting for. Thanks for watching.